In this video, I'm going to show you how to do a potential swing setup through options. So real quick, let's talk about the IWM. This is an IWM daily chart. As you can see, had a bit of support at that 210 area, got a good bounce, and then cracked underneath 210. And now it's coming to 210 from the bottom side, and 210 is acting as resistance. So look at all these interactions. That was support. Now it's starting to be a little bit of resistance or supply from the bottom side. If we just briefly look at something like the weekly time frame, so each candle represents a week on the IWM, you can see that there is a big bear flag that ended up dropping, and now there's an even bigger bear flag underneath resistance, and it could drop and test this former breakout area on the IWM of about $170 a share. So based off these factors, I am bearish on the IWM. I'm expecting it to most likely drop over the next, let's just say, about 6 months. So for each options trade, think, okay, what direction do we expect the ETF or stock to move? In this case, down. How far in that direction? We'll talk about that in a bit. And then when? This is a crucial part in options land, because normally when we're just buying or selling stock, we don't really have to worry about when it'll go up. You have as much time as you want to think about it, and there's not a lot of option Greeks that get into the way. So for this IWM setup, we're going to say the IWM is more likely to go down based off our trade idea, our trade thesis. And how far? Well, there's two potential targets. $190 a share would represent equal lows. So if we just pull up the IWM on the weekly time frame right here, we can see that, okay, if we're expecting equal lows, that's about $190 per share on the ETF. If we're expecting that former breakout area, that could be down, that could be down as low as about 169 to 170. So 170 is kind of the stretch target towards the downside on the IWM. So we've got our direction, we've got our time frame, and we have a rough idea on how far the IWM may be going. So if we just quickly go back to the presentation over here, let's look at one example. So let's just take a look at the September 30th 200 strike put. I'm going to go over this example, and then I'm going to go over a slightly better example that I think would better suit this trade. So right over here, IWM, you could go with the September 30th 200 strike put. What does that look like? Well, I like to pull up Robinhood just because the options chain is nice and simple, and it throws up a pretty good profit and loss graph. So let's say we think the IWM is going to be dropping, and let's just say we're going to grab a put option. Let's go to buy, put, expiration date, September 30th, and this is the 200 strike price, as you can see over here. So strike price, 200, and right there you can just see, okay, we have a max profit of 18,000. That's if the IWM absolutely tanks and the IWM goes to zero. That's not likely to occur. You're likely to get something in the middle of that. And our max loss is the premium, the total cost that we pay of $1,298. What you can also do is I have options profit calculator as a reference, because you can go and type in options profit calculator. I'll walk you through it real quick. Options profit calculator. You can just go over there. You can click on that. And you can go to long put, because we're bearish the stock. You can go to long put. Right over here, we type in symbol, IWM, click get price. We're buying the option, so make sure this says buy. Okay, select option. Okay, right over here, we're choosing the September 30th expiration date, because we expect the IWM within about 6 months to be down towards those levels. And we're going to go and select the 200 strike put option. There we go, it's all selected. We can go to manual settings. Okay, nothing over there. And we can click calculate. And I like to look at the output options. You might have to agree to some terms of service. And you can go to profit loss dollar value. And right over here, you can see this is a huge graph. And it shows, okay, this is the price of IWM on the left, and the green represents your profit. So as you can see, if the IWM drops right away, you can profit quite a bit on this put option. If it takes a long time to drop, though, you tend to give up quite a bit of gains as time moves on. And if you really want to, you can also take a look at this as a chart value. So right over here, we have the IWM, the share price on the bottom, the x-axis, and we have our profit on the y-axis. As you can see, if the IWM never sells off or goes below 200, you actually lose money. As the IWM rapidly sells off, you make quite a bit of money, but as time passes on, you make less and less money as theta decay takes over. So the big pros of the single put option is it's just one simple transaction. There's not a lot of slippage. There's not a lot of commissions. It's not that complicated. The cons are, though, is that this trade is not that asymmetrical. And what does that really mean? Well, this trade's kind of more of like a one-to-one. And we talked about targets on the IWM, 190, which is equal lows. So that'd be represented right here. And then 170, which would be kind of a lower low on the IWM. And if we take a look at the options profit calculator, if we go for that kind of one-to-one risk to reward, if it takes a while to do it by expiration date, you're only just making $1,300 and you're risking that premium $1,300. So basically the pros are that it's super simple to just buy a put, but the cons are, you might not get exactly the type of risk to reward that you're looking for, and there's just a better way to do it. And what's the better way to do it? Well, in my opinion, it's actually a put debit spread. You are buying a put and selling another put at the exact same time. It's also oftenly called a put vertical, but this is great because the pros are that it's very cost effective and it greatly reduces the theta decay because we're selling a put to finance the purchase of another put. And what's cool about this is you don't really need that perfect of an entry. See, when you're buying just a straight up put, you need to be on point. You need to have a precision entry. Otherwise, you can put yourself at a lot more risk, or you might lose a lot right away and you might just be kicked out of the trade before it even takes place. So what's super great about this, the put debit spread, is that it's an easy entry. You don't really have to worry about it. You can buy it super soon. You can be a little bit late to it. The cons are that it's a little bit lower probability because the 190 put is a slightly more out of the money than the 200 strike put. And the 180 put makes it so that we have capped gains. So before, our max profit was if the IWM absolutely tanked. But in this case, our max profit is 744. So what am I really talking about here? Let's demonstrate this on Robinhood. So we're going to go out to that September 30th expiration date, and we can buy the 190 strike put. So this is a little bit more aggressive. We want the stock, or the ETF in this case, to be beneath 190 when we're buying a 190 strike put. But in this case, we're also going to sell a put. So total cost, this would cost $955. I don't want to spend $955. That's quite a lot of money. So at the same time, I'm going to sell a put, and I'm going to scroll down, and I think the IWM maybe won't go too much lower than $180 per share. So I'm going to sell that put. And as you can see, it says minus right there. So I'm collecting a credit for that, making it just a smaller cost of $256. So now our max loss is $256 and our max profit is $744. And as long as the IWM is at that short strike, $180 per share or lower, you get that maximum profit of $744. So that's really cool because this is now what we're looking for. This is a 3-to-1 risk to reward, or 3-to-1 reward to risks. And that's always the name of the game. We want to risk a little bit to make a lot. And of course, we talked about the downsides, how it's a little bit less of a probability because we're more out of the money. But what's super cool about this is we can just adjust these as much as we need. So when in doubt, we can give ourselves a longer expiration date. You know, if I'm showing the September options, we can go out and do this exact same thing and construct it in November. So we can go out to November and let's say, okay, November, a little bit more time. Maybe I'll sell the 170 strike put since that was our stretch target. And maybe I want to buy the 185 strike put. Now we have this sort of risk to reward. Our max profit's $1,157 and our max loss is only $343. Again, that's that same 3-to-1 risk to reward. Now, what if I go even a little bit more out of the money? What if I buy the 180 put and then sell the 170 put? Okay, that's a little bit interesting. This one's about almost a 4-to-1 risk to reward. We're risking $212 to make $788. You can see the buy, that's the plus one. and you can see the sell, that's the -1. Long story short, in my opinion, it's a lot better to do a debit spread or a vertical spread than it is to just buy a straight up put option, especially when taking a swing trade that is 5 to 6 to 7 months out. What's super cool about this is you can exit at any time, you can exit the next day, you can exit before expiration, but what's really critical to remember is that the debit spreads receive the max profit at expiration versus when you're doing a put. For example, look at the long put, you kind of want to get out right away. The sooner, the better. But with a vertical, you generally have to wait until that expiration date for the stock price to give you that maximum profit. So on debit spreads, the most you can lose is the debit that you pay to open the trade. You can get as many of them as you want. Let's say okay, the total cost is 212. Let's say I want 3 of them. Okay, now look at the risk reward. Max loss 636. A maximum profit of 2,364. That's actually pretty good. But what's super cool about this is also it can still drop past the strike that you're selling. So even if the IWM still sells off beneath that 170 strike, so let's say the IWM absolutely tanks and, drops down to 100, that's cool. You still get your max profit. You still get your money. You just don't get any more money beyond that strike that you're selling. You just don't get paid more. Conversely, a butterfly is where you actually start to lose money if it goes past that strike. So not to be confused with a butterfly, this is a vertical spread. And even though you have a capped profit, you still want it to drop quite a bit because it'll give you that extra wiggle room to achieve the maximum profit. So that's just a quick little overview on how to profit off an options trade, off of a potential position swing trade, longer term type of trade. If we look at the monthly time frame, maybe we see multi-months of downside on the IWM. So you can pick yourself up some debit spreads. Feel free to play around with the different strikes, play around with the different risk rewards. You can be something like a little bit more conservative. Buy the 195 and you could sell the 170. Okay, what's this one look like? Max loss of 608, max profit of almost 1,900. So that's a 3-to-1 risk to reward with a pretty good, probability of occurring. Our options chain over here can show us the probability that IWM touches each of these levels by the expiration date. So what I'm looking at is prob touch, and prob touch over here, the 175 strike put, there's a 52% chance that at some point between now and September 30th, there's a 52% chance that the IWM just touches 175. So pretty cool to see and just read the options chart like that because it can do whatever. It can do a bunch of shenanigans. It can pop, it can flop all around. But if it ends up at that 175, that vertical spread is the way to go. And if it chops all around, you didn't want to buy just a straight up put. That put would get murdered. You only want to buy a put if you just expect it to just thunk right now. So a little difference in the way you can trade and express an idea through options. Thanks for tuning in. See ya.